This week on the Business Owner's Corner, I'd like to talk about the Augusta Rule, which falls under Section 280A of the tax code. It's a tax loophole that a lot of business owners have kind of heard about, but don't know all the ins and outs and all the details of. I'd like to explain those details in today's episode. Basically, the Augusta Rule comes directly from Augusta National, the golf course down in Georgia that hosts the Masters PGA Tour tournament every single year. And the history here is that Augusta, Georgia just happens to not have a whole lot of hotels. But Augusta National draws a whole lot of people who want to come see that golf tournament every single year. And so what homeowners did in the area surrounding the golf course was they started renting out their homes. There wasn't a VRBO years and years ago, but I would imagine that they're probably doing that through a VRBO or Airbnb today. Years ago, anyone who rented their house out, even if it was for 4 days, a 4-day golf tournament, was required to report that rental income on their tax return and pay taxes on it. And they were not happy about that. And so they wrote letters to their senators. They created enough momentum and lobbying and complained about it enough to actually get the tax code changed eventually. And now in Section 280A, it's known as the Augusta Rule, which basically says that you can rent out your house for up to 14 days per year, and you don't have to report any of that income on your tax return. So you don't pay tax on it at all. If you rent it out for 14 days or more, I believe the threshold is right at 14 or more days throughout the course of a year, you do have to report the rental income on your tax return and pay tax on it. Well, this is very helpful for business owners, particularly owners of S corporations and LLCs, because it enables you to have your business rent out your own house and deduct the expense on your business return. So here's an example of why that would be helpful. Let's say that you have an LLC, you make $100,000 in self-employment income. You have to pay tax on that $100,000. But if the going rate for a house of your size in your neighborhood, based on comps from places like Zillow, is maybe $150 a day, well, if you rented your house out for 10 days back to your business because your business needed to host events or do something else, then that's a $1,500 deduction. $150 a day times 10 days, that's a $1,500 deduction for your business. It has to be for a legitimate business use. So in that example, you have $100,000 of self-employment income. You find another $1,500 deduction by having your business rent your house for a few days. Now you're only paying tax on $98,500 of income. So you save a little bit in tax by doing that. You can't just say that you rented the house for no reason. It has to be for a legitimate business use under, I believe, Section 162. So examples of that are you can host events. You could throw a client appreciation event at your house. You could, if you make cookies, you could make the cookies out of the oven in your kitchen maybe instead of a shop if you rent space. I'm just kind of pulling things out of thin air here. Maybe an employee appreciation event, but it has to be a legitimate use. You can't just make this stuff up. So make sure you have documentation around it. Make sure you have documentation of the comps in your area to support the daily rate that you're charging the business for use of your home. But it's a nice loophole and a nice deduction that will definitely help you save money on taxes if used properly.